Hey everyone, welcome back. Today we are diving into one of the fastest growing financial instrument in the world, that is bond. What is actually meant by bond? Let us discuss or understand in simple way. A bond is basically a loan. When you buy a bond, you are lending money to a company or a government, and in return they promise to pay you back with an interest. Think of it like giving your friend 1,000 and they agree to pay you back rupees 1,200 after an year. Simple, right? You got extra rupees 200 as interest. But here is the twist. Not all bonds may work in the same way. Before going into a detailed explanation, let me introduce myself. My name is Nixon Mandir. Today we are going to discuss about two variety types of bond, that is CoCo bond and Islamic Sukuk bond. Islamic Sukuk bond. This is an modern investment option, but it is actually based on a system about 1,400 years old. May to surprise, but yeah. Sukuk follows the Islamic financial principles and are basically ancient trade system which is used during the times of Prophet Muhammad. But how did the Sukuk evolve from those early days into a modern financial market and a leading financial instrument? And why it is gaining global attention? Let's break it down in simple way as possible with examples. What is Sukuk bond? Sukuk bond is an Islamic financial instrument which is very similar to bonds but follows an Sharia law. Sharia law is an Islamic principle where the Islam peoples cannot collect interest from others. Then what is the key difference between the traditional bond and Sukuk bond? In traditional bond, we may charge us interest, which is forbidden in Islam. While Sukuk allow investors to earn profit from real assets. Instead of lending money, investors may become the co-owner of the project after issuing the Sukuk bond, like the constructions of a shopping mall, highway, etc., and earn profit from its revenue. How actually the Sukuk bond may works? A company or government may issue Sukuk bond in order to have a generation of asset or constructions of an asset. The investors buy Sukuk bond and will become the co-owner of that asset. For example, constructions of highway, airport, mall, etc. Then asset may generate the revenue. Taking an example, we may issue the Sukuk bond in order to have a construction for an airport. Then after the complete constructions of that airport, the airport may generate the revenue in form of tolls, airline charges, etc. Then the investors get profit based on the revenue generation from the airport. At the end of the Sukuk year, the issuer buybacks the Sukuk and may retain the investors' principal money. This is all about how actually a Sukuk may works. This is a pictorial representation of how the Sukuk bond may works. The money from the investors is invested in Sukuk bond, and the investors' money is placed into the assets of a project or an investment. When the investors will get a profit based on pre-agreed ratio as per the terms of Sukuk bond. And the profit from the Sukuk bond may generate according to the revenue generation from that asset. Sometimes it may yield losses, sometimes it may have profit. It's based on the revenue generation activities of that assets. This is all about how the Sukuk bond may work. Where is Sukuk bond is widely used? Sukuk bond is widely used in Islamic countries, that is Muslim countries, but it is also used in non-Islamic countries too. Islamic countries like Saudi Arabia, which is use Sukuk bond for infrastructure constructions. UAE, that is mainly Dubai airport, is constructed by issuing the Sukuk bond. In Malaysia, Indonesia, and the countries like UK is a wide user of Sukuk bond, and in Turkey and in Europe like Portugal, Spain, etc. They are widely users of Sukuk bond. Whether the Sukuk bond is used in India? No, the Sukuk bond is may not used in India as the India has a interest-based financial laws as they cannot use the Sukuk bond. But the Kerala, which is a state in India, once proposed to use the Sukuk bond in 2016 for the infrastructure constructions. but it was denied by the State Assembly Board of Kerala itself. Let's take an example in order to have a deep understanding about how actually the Sukuk bond may works. Here, a government wants to construct an highway. In order to fund for their highway project, the government issues rupees 1000 crores worth Sukuk bond. The investors who buy the Sukuk bond may become the co-owner of that highway. After the complete constructions of that highway, the highway may generate the revenue in the form of toll fees. In this example, the highway collects rupees 200 crore per year as its revenue in the form of toll fees. In this example, we also have an expenses that is in the form of maintenance cost of rupees 15 crore. Then the net profit may be calculated using equation income minus expenses, that we have an income of rupees 200 crore and an expenses of rupees 15 crore is deducted from 200 crore. Then we have a net profit of rupees 115 crore per year. The investors earn 115 crore per year for 10 years. This is the time period for the Sukuk bond. After the 10th year, the government buy back that Sukuk bond and repays the principal amount rupees 1000 crore. Then the total earnings for the investors may be 1500 crores that they have generated as profit in 10 years plus the 1000 crore principal amount which has been repaid at the 10th year. Then they may have a total earnings of rupees 2500 crores. This is all about Sukuk bond may works. Then what is the difference between the Sukuk bond and traditional bond? In traditional bond, if the traditional bond is issued for 1000 crores, then they may have an interest of 5% fixed interest. Then they may generate rupees 15 crores per year as their interest. Then they may have a total interest of rupees 500 crores in 10 years. So they may get a total earnings of rupees 500 crores interest plus 1000 crores principal amount, that is 1500 crores. But in Sukuk bond, we get rupees 2500 crores as our earnings, which is 1000 crores more. So issuing Sukuk bond may beneficial for the investors. This is how actually a Sukuk bond may works. Then this is all about the Sukuk bond. Hope you understand about the concept. Thank you for your valuable time and listening. The continuations of video where we will discuss about CoCo bonds will be explained by the Joseph. Thank you.
So hello guys, my name is Joseph Thomas. So today let's understand about a new bond called CoCo bond. As an introduction, CoCo bond is contingent convertible bond are a type of hybrid financial instrument. They work like a bond but can be converted into equity shares under specific conditions. So CoCo bond are a unique financial instrument primarily used by banks to strengthen their capital structure. These bonds function like a regular bonds, providing investors with a periodic interest payment. However, they came with a special condition. If the bank faces any financial stress or its capital falls below a certain level, the bonds automatically convert into equity or gets written down. So CoCo bonds are introduced after 2008 financial crisis to help the bank absorb losses and prevent collapse. They are considered high risk, high reward investment, attracting investors who seek high return but are willing to take risk, conversion or losses, which means that high risk, high return. So how CoCo bond works? A bank issues CoCo bonds to raise money. First of all, bank issues the CoCo bond in order to raise their money. Then investors buy these bonds and receive regular interest payment. If the bank stays financially strong, investors get their bank at a maturity. So if the bank capital falls below a certain level, CoCo bond which is converted into shares. Now investors through that the investors now become the bond holders. So that is how CoCo bond works, which means that first of all the bank issues their money and the investors will buy the bond, and if the bank goes down, the bond will be converted into shares and the investors will become the bond holders. Then countries using CoCo bonds are mostly by United Kingdom. Barclays Bank issued CoCo bond after the 2008 financial crisis. I think everyone knows about the financial crisis faced by the European countries, which is regarding to the real estate, in which they had a boom and the regression. That is the 2008 crisis. Then it is used by Switzerland, USB and Credit use them to absorb losses. Then in Germany, Deutsche Bank raised capital through CoCo bond, and in Spain, Standard Bank issues CoCo bond to boost reserves, and in France, BNP Paribas uses CoCo bond as a financial safeguard. So here we are going to explain a example. Imagine ABC Bank, a large financial institution, need to raise rupees 1 crore to strengthen its financial position. Instead of issuing regular bonds, it decided to issue CoCo bond with following claims. First of all, here they given a bond size of rupees 1000 crore and an interest rate of 8% per year, higher than the normal bond due to the risk, which it has high risk. The maturity period is 10 years. Trigger levels: if the bank capital ratio falls below 7%, the bond will be converted into shares. As I explained earlier, if the bank faces any financial crisis, this will be converted into shares. And they gave a line which is 7%. If it go below 7%, it will be converted into shares. So example, so scenario 1, bank perform well. When the bank perform well, means bank does not face any financial crisis, there is no need for conversion. In that case, the outcome for investors will be like this. Investors earn rupees 80 crore per year, 8% interest on 1000 crore. Over 10 years, they will receive around rupees 800 crores in total interest. At maturity, the bank repays rupees 1000 crores to the bondholders. So total earnings for the investors will be 1000 crore plus 800 crore is equal to 1800 crore payout. Investors benefit from the stable return just like the traditional bond. So in this case, the bank perform well, means the bank does not face any financial crisis, and the investors will get a huge return of 1800 crore as a payout. So that is regarding the scenario 1. So let's go to scenario 2, when bank faces any kind of issues or financial trouble. In that case, this bond is converted into shares. So in 5 years, the bank capital ratio drops to 7% due to heavy losses. As earlier in the example, we mentioned that 7% would be the line. Means if it goes below 7%, it will be converted into shares. So in this case, in scenario 2, it goes 6% to 6%. So the CoCo bond converted into shares instead of repayment. So in that case, this bond is converted into shares instead of repayment. Means the bank is not in a stage to repay to their shareholders. So the investors now own the equity shares in ABC Bank instead of bond. So now they become the shareholders of the bank. So outcome for the investors: if the bank recovers, means if the stock price rises and the investors make profit from selling shares. We know that how stock works. So if bond is converted into shares and the share values increases, this will be a benefit for the shareholders. So if this bank struggles further, which means that the stock price drop down, and investors, in that case, what will happen? The investors will lose the money. So this is scenario 2. So example share price impact. If rupees 1000 crore worth of bond converted into 10 crore shares, each shares would be worth 100 initially. If the bank perform well and the shares price rises to 150, the investors make a rupees 500 crore, which means a total of 1500 crore total value. If the bank struggles and the share price drops to 50, investors lose rupees 500 crore. So that's all about CoCo bond. I think everyone understands the CoCo bond. So